Hello everyone, welcome to the channel. This is Investing Kala or the art of investing. In this channel, we will cover different concepts related to stock market investing. Given that this is an introductory video, we will cover two topics. The first one is why should everyone invest? And the second is what is the investment style that will be followed as part of this channel. Now, before we talk about investment in the stock market, wanted to call out that irrespective of the way of investing, investment in securities are always subject to market risk. Irrespective of how careful you are, there is always the chance that the market might go down. Second, we are not SEBI registered, and the objective of this channel is for only educational and learning purposes. We will never recommend investment in a stock. However, you can learn about the process by which we go about investment and make your own decisions while trading or investing. So why should we invest in the market when markets are inherently risky? The data below shows why should everyone invest in the market. The data lists down the return that an individual will get as part of investment in different asset classes. On the left, we have investments in bank deposits, where over the course of the last 3 to 4 years, an investor would have realized around 6 to 8% return in the form of FDs or savings bank accounts. As opposed to that, equities over the last 4 years have given approximately 16 to 18% return. Given that the return on equities has been 2x what individuals would get in bank deposits, there has been a change in behavior from people actively investing into the stock market. And that is what the data is also reflecting. This chart also comes from the same report, which highlights how savings behavior in India has changed. What is very apparent between the two time periods is a drop in savings in bank deposits. This was as high as 45% in 2011 to 2020, which has fallen to below 40%, which is a big concern for banks. Where have all of these savings gone? These have gone into high yielding assets of equities and mutual funds. So the next logical question is it the right time for me to invest in the market? We will answer that question using the data highlighted on the screen. This table shows the return that Nifty 50 has given over the course of the last 23 years. Nifty 50 is the collection of the top 50 stocks in the market. So we will use that as a proxy for how the market performed. What you will immediately see in the data is that there are periods where the Nifty performed really well. So for instance, in 2009, the return on the Nifty was 75%. In 2014, it was 31%. And even in 2023, we got nearly 20% return on the market. However, there are also times when the Nifty fell down. So in 2008, where the market crashed, Nifty effectively halved. Similarly, in the year 2000 and 2001, the Nifty gave negative returns. However, the key thing to note in all of this is the long-term return that the Nifty has given, which is represented in the last column. So what you will notice is over a 23-year period, Nifty has on an average given around 11 to 12% return, which means that if you had invested 1 lakh rupee in the year 2000, you would have gotten nearly 14.5 lakhs at the start of 2024. So what this just means is that if you are consistent in the market, you will make around at least 11 to 12% in the long run. So in summary, investments in equities and mutual funds in the long run will help you defeat inflation and create long-term wealth. The key in all of this is to have a system so that you can consistently invest in the market. Let's talk about two different investment styles when it comes to investing in equities. The first one is momentum investing and the second one is fundamental investing. A lot of what we will cover in our channel is momentum investing because that is the preference that I have towards investing. However, having said that, there is no one right style for everyone. There are a lot of big investors like Warren Buffett, etc., who do fundamental investing. The big thing that you have to think about is what is the investment style that you feel comfortable doing over the course of a long period of time so that you can create consistent returns in the market. Quickly covering the two styles. Momentum investing capitalizes on trends in the market, and invariably momentum investors will buy high, but they will like to sell higher. On the other hand, fundamental investing actually deals with looking at basic fundamentals regarding the business. So for instance, you will look at the balance sheet, the profit and loss statement, and how fundamentally the company is doing before investing. In this investment style, you will tend to buy low and sell high. Now, in terms of investment horizon, because momentum investing is primarily about trends, so this is a short to medium term investing style. So typically you will hold the stocks for a few weeks or a few months, as opposed to fundamental investors who will typically hold on to stocks for a very long period of time, typically years, to get return out of that investment. Now, given that this momentum investor is primarily looking at trends, this is higher risk because there is a lot of volatility in the market. Because fundamental investors are holding the stock for a long period of time, the volatility in the market, the volatility in the stock reduces and you are able to get return out of it. In terms of market conditions also, momentum investing works very well in terms of trending market. So either the market is going up or the market is coming down. However, fundamental investors, because they hold the stock for a long period of time, they will recognize returns in the long term. We've already covered the drawbacks. So in momentum investing, you will typically get a higher risk, but you can also realize a higher return on momentum investing, as opposed to fundamental investing where you are playing the long game. The big thing that you need to have for fundamental investing is patience to realize the value that comes out of the stock. That's it for today's video. We will come back and analyze a few stocks in the upcoming videos.